Afternoon. I'm Emily Ackerman, the Director of Business Development here at Lane Gorman Truitt. Today's webinar is the fourth installment of our 8-part series, Aiming Towards Success. Today, we will be discussing the employee stock ownership plans with Doug Janowski from Lazear Capital Partners. We are excited to be offering a diverse selection of webinars in 2022. And to tell those of you joining for the first time today, Lane Gorman Truitt is a mid-sized accounting firm for all business sizes. And in 2022, LGT will be providing you endless opportunities for gaining CPE credit. These events are created to help your business grow and thrive. We cover a broad range of topics that are impactful to businesses in the construction, manufacturing and distribution, dealership services, real estate, and not-for-profit industries this year. But we always want to make sure we are providing you with the topics that you need more information about. As we go through the presentation today, feel free to share your attendance with us on social media and give a tag or use hashtag 1LGT. If you have any questions about this or any of our services, or would like to set up a free consultation to determine how we can help your company or organization, please send us an email at askus@lgt-cpa.com. All of these links will be included in the chat. With that being said, let me introduce you to our star and presenter today, Doug Janowski. Doug is the Managing Director with Lazear Capital Partners at the Dallas office, focusing primarily on Texas and surrounding Southern United States. He helps business owners and their advisors understand succession planning options and determine if selling the company to an ESOP is the right solution. Doug also oversees coordination between the company, its advisors, and the team at Lazear Capital to help plan, execute, and ensure successful outcomes and meet all the agreed upon objectives. He draws on a wealth of industry knowledge and 20 years of professional experience in financial services, accounting, and general ledger systems, professional services, enterprise software, business intelligence, data analytics, insurance and risk management, and tax and audit regulatory compliance. I cannot wait for y'all to meet and hear this wonderful presentation from my friend and great resource for me, Doug Janowski. Doug, you have the floor.
Perfect. Thank you, Emily. I wasn't expecting that much of an introduction, so very much appreciate it. No, it's okay. Thank you to Emily. Obviously, thank you to the team here at Lane Gorman. I appreciate the opportunity to get to come out here. I appreciate you inviting me into your offices. Obviously, much better decorated than my offices, so thank you again. Welcome, everybody. So what we're going to talk about today is employee ownership, often referred to as its proper name, ESOPs. And specifically, this is a really widespread tool used by businesses and owners as a succession plan or exit strategy. However, it is very often surprising to find how many owners either are not aware of it as an option or have some misunderstandings about how it works, because it is different from a traditional exit plan, i.e. selling the business. And so there's some things we'll go through. We'll start very high level and we'll get into some of the details because we get a lot of questions about how these work. So kind of jump in. I love this quote by our founding partner. I'm not going to read it to you, but Bruce Lazear, really great person to get to work with and for. Bruce began his career as an M&A, merger and acquisition attorney, as well as tax planning. And during his career, he worked on hundreds of traditional sell side, buy side engagements. So he worked with different owners and buyers. And you know, the one thing that I always impresses upon me is when he says, the outcome was always very similar, right? You're buying a business, you're selling a business, you're buying a business. However, once Bruce formed the firm that we now work with today, he and the other partners began to work with ESOPs, and he really attracted them because of the nature of how flexible the structure was to be able to accomplish not only the goals of the owner financially, but also to address a number of other aspects of what they were trying to do. So personal and financial goals, we'll talk about some of those. So it really was the flexibility and all of the various outcomes that could be produced, which really drove our firm over the last 20 years. So I'll go through these two slides pretty quickly, but just a little bit about us. So our firm is just coming up on 23 years. You'll notice on the left, it talks about we do sell-side engagements, recapitalizations, we have all those capabilities, and we do those for former clients when requested or friends of the firm. But at our core, we are predominantly focused on ESOP advisory. That includes feasibility analysis, structures, and then ultimately formations if it makes sense for the owners and the management team. We've got advisors across the country. As Emily mentioned, I'm here in Dallas, so I've had the fortune of working with the Lane Gorman team, as we were discussing earlier, for well over 15 years. So I've gotten to know them very, very well. And because of the unique nature and the structure and all the various outcomes that this can produce, we have assembled over the years a highly expert group of people, expertise, to help address all the various outcomes of our engagements for our clients. So, anyone who would like to go to our website, look at the backgrounds. We have tax attorneys, we have CPAs, we have senior lenders, valuation experts, people who have been CEOs of companies, and they have a broad expertise in construction, manufacturing, distribution, healthcare. What's important is we do not do the work that Elaine Gorman does. We don't sell CPA services. We are not billable tax attorneys. We are not lenders. But we have assembled this team so that when we are working with owners and management, we have the ability to maximize those outcomes in every aspect of the business and what their desired goals and outcomes are for their personal wealth, their employees, their management succession, et cetera. And so we'll talk a little bit more about how that works into a succession plan for the owners. So the first thing we do is we sit down with owners and we identify their financial goals. Now, obviously in a webinar, we would spend a lot of time with the owner going through each of these to understand what their desired outcomes are, but we can't do that in a group setting. But we'll kind of walk through, and this is similar to selling your business in the traditional sense, that, right off the bat, the number one concern for owners is almost always getting a full and fair value for the business. This is what I find is probably one of the most misunderstood aspects of employee ownership. There's this perception or maybe a misunderstanding that somehow if I were to evaluate transitioning the business to my employees, I might somehow receive less than full fair market value. So if we just take a second and talk about full fair market value, what full fair market value is whatever your business is worth at that time based on its size, its financials, the industry, the geography. So the best analogy you might think of is if you were to go sell your house is worth $1 million, and you were to go get an appraisal for what other comparable houses sold for, but then adjusted because you put in a pool and you did a bunch of landscaping and you redid the kitchen. And then they came back and said, this is what your house is selling for comparably in the last 6 months based on all of these criteria. An ESOP gets to pay full fair market value for a business. So if you think about, there's different kinds of buyers out there. If you were to do a traditional exit, which might be a private equity or a financial buyer, and that same analogy would be like an investor, a real estate investor. They're not going to pay more than what other comparable houses are going for. So it is full fair market. They're actually looking as financial investors to make a return on their investment. So they're looking to buy things for even under full fair market value. Now, full disclosure, one of the other options that we are always upfront with owners is to sell to a strategic or a competitor. And by strategic, there are people who are often consolidating businesses in a certain category, or they have horizontal or vertical integration, or it's a competitor. And they will often pay higher than full fair market value because they have synergies. Now, they might have better technology they can implement. They might have supply chain that they can provide or vendor relationships, but they also have part of those synergies are people. So as a soft cost of a transaction, they can pay more because they also can look at a business and say, look, we don't need 2 CFOs. We don't need 2 HR directors. We don't need 2 directors of operations. So cost savings come from efficiency and people. And we are, if that's a lot of owners we meet with, if that's the direction they want to go, not a problem. We are capitalists by heart. You've built an amazing company. We hope so. But to get above full fair market value, you've got to look at synergies in those aspects. I think the biggest one we run into is the second bubble, which is the concentration of wealth. The vast majority of owners that I meet with are 55 and older, and the predominant or almost all of their concentration of wealth is built into their company. And they're sort of playing this waiting game of, I want to keep building my business, and I know that when I do sell and exit, I'll get full fair market value to an external buyer, but they want to keep running it and the biggest concern they have is, what if something tragic were to happen? What if I were to get sick? What if I were to pass away? And it's very often their spouses who are talking to them, or their significant others who are saying, you have everything tied up in this business, and we've got to begin to start get some of those proceeds out of that so we can make plans for other things in our lives. And so this is where we start to differ a little bit between the business or the financial goals and the personal goals. So part of what an employee ownership transition can allow someone to do is to decouple that concentration of wealth being in the company and begin to move that into other things while still running and operating and building the business over the next 5, 7, 10 years. So we've spent a lot of time with owners talking about this, because that's where a lot of their concern is. Can I provide resources for my family? Can I begin doing estate planning? And can I still participate, which we call second bite at the apple? Can I still participate in that growth 5, 6 years down the road? So all of these things come into the financial goals, which then lead to something that we do feel is very unique to ESOP formations, which is, how does this then portray into their personal goals? So for a lot of our owners, and this is not a general, this is people who are attracted to this as a succession plan. So for a lot of them, they really enjoy what they do. They enjoy going into the office. They enjoy the people they work with. They enjoy their customers, their vendors, their association events, and they don't know what they would do without that. So I actually just met this morning with someone who has a 70-year-old owner, and all he wants to do is be out in the field. But there's this kind of conflict of, can you get some of the proceeds out and start doing some things for the family's welfare, for estate, et cetera. So we'll probably end up talking to an owner like that. Preserving your culture. There's a lot of owners, and this was a real big one. I think all of us who went through the financial crises of 2001, 2008, 2012, these were financial crises. And so it is part of the country. Obviously, some of those were very impactful in other parts, but in our southern part of the area, they were financial in nature. So it was batten down the hatches. It was reduce expenses. It was, let's get through this and weather the storm. At least the owners I've talked to, 2020 is very different. They, especially a lot of these that were older, above the 55 and 60, which they call the silver tsunami, which is these baby boomer run companies that are trying to figure out what to do next. But a lot of these owners saw their employees coming in. It wasn't just financial. It was PPP loans, it was supply chain issues, it was finding new vendors, it was stickers on the floor, it was plexiglass, it was N95 masks. They saw their employees do things, and I've had owners tell me, I don't know if my business would be in the place it is today without them. And that culture really hit home to them, that this is something that has really made them successful. Charitable options, that's kind of a binary. People really like charity, they're into it. If they're not, that, again, no judgment. However, I will share, and I got the fortune of being on with an owner, and Bruce Lazear again, and he was talking about charity, and he said, we're in a low tax state. Let's just pay the 20% taxes. Whether I walk away with 100 million or 80 million doesn't really matter to me. My steaks aren't going to get any better. My wine's not going to get any better. And Bruce posed the question, okay, I appreciate that, but just something to consider is, you could pay that $20 million. We'll talk about these tax advantages here in a second. You could pay that $20 million to the government, and they could decide how to use it. Or you could eliminate that 20% cap gains on the sale of the business, and then you could decide how to distribute that. You could give it to your alma mater, your university, your local hospital, your local schools and charities. And that even gave this owner pause, where he said, I hadn't considered that. I might kind of think through that. So again, this goes back to why we have all these advisors in different areas to look at all these different aspects. Obviously, change the employees' lives, protect the legacy. I know we've got a limited amount of time here, so I'll go into each of these. This one on the bottom left, create a life plan less centered on work. This is probably one of the most important for owners. There's a lot of owners, again, who have that 5-7 year timeline where they want to keep working, but maybe they want to incentivize that next generation, make sure they retain them, and also start moving some of the work they don't enjoy doing down to the payroll, operations, running the day-to-day business. They want to be more the face of the operation. So talked with one owner, he said, hey, I want to, right now I'm working 4 days a week. I want to go next year to 3 days a week, the year after to 2 days a week, the year after to 1 day. So the owner, because they're actually designing the employee ownership option and then choosing whether they want to pursue it, they to decide what that plan looks like for them. And then the next one is operational control. Probably the biggest concern we run into with owners is, well, if I do this, if I sell my business, let's just take a financial sale, I definitely am going to lose control, right? I'm selling the business. If you can go look at this Exit Planning Institute, you Google the statistic, they did a survey, 75% of owners who sell their business in a traditional model, they profoundly regret it within 1 year. 75%, 3/4. That's the Exit Planning Institute.
Wow.
Owners are well aware of this. They are very much attuned that they could sell their business. They get 6 to 8 unsolicited offers a year, so they know they could sell. But what they also want to make sure is that they can continue to control and run the business. And that's what an ESOP or an employee-owned business allows them to do. And the way we do that, and I can't get into too much of the details, but one of the big myths or misunderstandings is that the employees are going to become shareholders. The employees in an employee-owned business are not shareholders. The shares are held in trust for them in retirement. There's only one shareholder, the ESOP. As part of a formation, we're going to create a board of directors. The owner is going to be on the board. Typically, they're going to pick the board of directors, and that board of directors is going to continue to operate and control the business as long as they're not doing anything to harm the employees. But that gets to do a little bit more. And then protect your community. Emily, you know this, we're here in Dallas. You know, you don't really think about the impact of a business to the Dallas community. It's large, it's diversified, but that is quite different. I think about when I would go visit my parents in Gonzales, Texas, and we would stop in Brenham. Well, Bluebell Ice Cream, for anyone who doesn't know, employs more people in Brenham, Texas than any other company. I've had the fortune of meeting the CEO of Bluebell. He grew up there. He played Little League Baseball there. He goes to church with all those people. It weighs on people in towns like Weatherford, Sulphur Springs, Brenham, that this has a big impact on the people around them. Their kids play together. They go to church together. They know each other. And so we get to go into and spend a lot of time making sure we can address not just the financial goals, but the personal goals of the owners. So what is an ESOP? So I won't read all of this, but an ESOP is a retirement plan. It is a qualified retirement plan. And the reason they were created was a long time ago, Congress recognized that Social Security as a safety net was not going to be enough to provide retirements for everybody just based on checks and the contributions. So they wanted another way to incent owners to look at transitioning to their employees. And one of my favorite quotes is because the problem with capitalism is there are not enough capitalists. I think, Emily, you've heard me say that in the past. The idea was that if we can create more business owners and more wealth in their plans, and so for that reason, they gave this option several incentives above and beyond other traditional exits, and we'll get into those in a second. So I mentioned a 401k plan. So the easiest way to understand an ESOP as compared to a 401k is to look at what a 401k is. So a 401k, employees contribute their own money, some level of matching from the employer, and then those proceeds are invested into GM, IBM, Apple stocks, bonds, etc. An ESOP, very similarly, except that the employees don't have to contribute any money. They take no personal risk and they use none of their own funds. So this is one of the other misunderstandings I meet with owners who say, my employees can't afford to buy me out. Well, they don't use any of their money. We'll go into a little detail on at a high level how that works. I don't love the word granted here because they're not really granted their shares. They earn their shares. They earn their shares by working and productivity over time, and then they vest into those shares. So they transition into the ownership of the business. And the ESOP, as opposed to the 401k, which is in all these different stocks, it only holds one stock, which is the stock of the company that the owner is transitioning. So it just has the private company stock in it, which is growing and being built to buy out the owner and also to provide retirement for the employees, the management team. So what incentives did Congress give to have owners and management teams look at this as an option? So there was two significant components, which is one, they gave owners an opportunity to receive proceeds from the business and either defer the capital gains tax on it or ultimately using some sophisticated strategies, eliminate them altogether. So what that means, and no other buyer will really get into after tax proceeds because they can't affect those. They are what they are. But an employee-owned business or an ESOP transition using a 1042 exchange, there's several ways to go about this, but it's similar to a 1031. A lot of people know a 1031 exchange. like-kind exchange, sell a building, buy a building, defer taxes. This effectively works in the same way, but specific to a transition to employees. The second benefit is that the business can then become owned by the ESOP. So it's owned by the retirement plan. Well, just like a 401k doesn't pay income tax or capital gains taxes, nor does an ESOP because it's a qualified retirement plan. What that means is the business then going forward doesn't pay federal or state income taxes, which allows it to give more proceeds to the seller and provides more benefits to the management employee team or the employees. So at the highest level, an opportunity to sell tax-free for the owner and then for the business to become tax-free. So those are two big components that get into the structure. And there's lots of different ways to structure this, but at the highest level, those are two of the big concepts. So why did Congress want more employee-owned businesses? So if you go to Rutgers University, it is the preeminent business school that studies employee-owned businesses, ESOPs. They've done study after study, and I think just intuitively we all know this. As soon as an ESOP is formed, productivity increases, sales increase, retention of key employees increases, the ability to attract employees. A lot of the owners I've met recently, they're getting tired of this, churn of people moving and going from place to place. They're looking for a way to retain all of their key people, develop them over the next 4 or 5 years, allow them to transition over that time period, and also attract other people. I have talked to several 40-year-old that management team, say in construction or in engineering, they will actually look at an employee-owned business as a place to go. And I've also talked to the people who work for them and say it's why I'm here. So it's a significant advantage for those businesses. As far as the employees themselves, again, they make higher wages, they're more likely to sustain. They did a study
I would think that'd be a really good recruitment tool as well.
100%, especially if you're trying to find that 40-year-old management person.
Mm-hmm.
You can definitely, I'll talk about that in a little bit, how you can set this up as a way to actually recruit for those key positions. So just high level, people think, okay, these are kind of an anomaly or I don't run into them. After this webinar, I would ask you to drive around, look at people who are employee-owned businesses, they put it everywhere. It's on their billboards, it's on their trucks, it's on their website. My favorite question is someone says, hey, do you know if this is an employee-owned business? I say, just go to their website. It'll say. So one of my favorites is TD Industries, which says excellence through employee ownership on every truck.
Is that the photo you sent me one time?
It was. So they are prevalent. There are over 7,000 ESOP plans across the country. They are predominant in the Midwest and the South. I'll leave that to you to conjecture as to why, but they are very popular. A lot of it because it's the same industries, Emily, that your firm works in, that they tend to attract to these logistics, professional services, construction. They're widely distributed across verticals and regions. And then there's also sometimes a perception, well, this only makes sense for big, public supermarkets and Avis and these types of things. 80% of all ESOPs are in companies with less than 300 employees. As a matter of fact, it often makes more sense in those businesses because you're trying to really, at that level, have an advantage to attracting and keeping those people. So talked about a lot of the good things. So what is an ESOP not? And we meet with a lot of owners and we're very upfront. We're not trying to convince everyone. It fits where it fits and it fits very well for those owners looking for this. But what it is not an all cash sale. So I had a good friend of mine who contacted me, went to lunch, owns a business. He said, I want to sell my company. I want all of the proceeds now. I don't have anyone to run it or succession. That's for the next person. And I want to play golf every day. Good for him, right? Like that's the definition of success. It's not an ESOP. I said, hey, that's a traditional sale and I can help introduce advisors who do that all day long. But this is a transaction over time. So you have to have a succession plan. You have to have a plan for going forward. As Bruce, Ted, the partners here say, the business is the goose that laid the golden egg. It is the critical element of the whole thing. It's what's buying out the owner. It's what's providing the retirement for the employees. It's what's providing incentives to management. It's getting everyone rowing in the direction. It is really the most critical aspect. those future earnings provide the majority of the payments. So this is not for a distressed company. It's not for a turnaround situation. It's really for amazing companies that are second, third generation, or have just grown so rapidly and truly have a great culture. So we're very upfront with what they're not. So I won't go through all of this, but there's a lot of flexibility in how they're structured. But I like to talk about this because there's some misunderstandings when people think about how these actually operate. So I always jump down to the very fourth bullet point. I probably should just move it to the first bullet point. So Emily, if we're in an employee-owned business, and there's some variation of this, but 80% of the time it's going to be set up this way. If you're making $200,000 a year, I'm making $50,000 a year, you're going to get allocated 4 times as many shares as I am. Just a straight line equation. So shares are allocated based upon compensation. You can create point systems and do more complex things, but that's the general best way to do it. Then, even though those shares are being allocated to them, they're not ours yet. We have to vest into those. So going back to the top, we have to stay with the company 2 years, 3 years, 4 years, 6 years to get 100% vested. So we have to earn those shares that we've been allocated. This is a big question I get a lot of time. We don't just allocate all of them in 6 years. The shares, we meet an owner, we take the company, we turn it into 1 million shares because nobody wants to get allocated 0.67 shares a year. You want to give them 300, 400, 500. So we turn it into 1 million, and then we allocate those over a 30-year period, not just in the 6 years. So you're earning your shares, or you're being allocated your shares, and then you're vesting into those. If you leave prior to vesting, those shares are forfeit back to the plan and reallocated to the people who stay, which continues to incent those people to stay with the business. Repurchase obligations, as people begin to, there's involuntary leaving, which is death, disability, or just retiring. Those are spread out over a 5-year payment. Question I get all the time from an owner is, what if a key management people or two get poached by a competitor and leave? Am I going to have this huge financial burden? Well, you can see under other termination, there's a 5-year waiting period followed by a 5-year payout. So there's a smoothing effect across all of these things to make sure, again, thinking about the company as the goose that laid a golden egg, we want to make sure nothing's impacting the business, which is why they're so resilient. So these are the key, and we get into a lot more discussion, but there's a lot of pieces in this that people just like to see and understand how the machine sort of works. And then annually there's a valuation, because when we form an ESOP, the stock has a price, let's say it's $15 a share. Well, you've got to be able to go back and show the employees after year one, now it's worth $20 a share. And your productivity and what you're doing to drive the sales and reduce expenses are having an impact on your own retirement. The next year it's 25. That's just an annual exercise to update the stock price, if you will. So that's the structure you get into. Now, the other question I get is, what does it take to form an ESOP? So one of our roles is to bring together all of the parties that form this engagement. This is once an owner feels, okay, this addresses my goals. I want to stay on for 6-7 more years. I want to get my management team as part of the ownership. So once we're engaged, we represent the owners and the employees. There has to be a counsel brought in. Now, again, this doesn't replace the owner's general counsel or their attorney, but they're not an ERISA ESOP expert. So we'll bring in someone just for the purpose of representing them in this formation. The accounting firm, Lane Gorman, we want to be able to make sure that they're involved in the entire process so they know what's going on with the proceeds in the business. A third-party administrator, just like a 401k has to be administered, someone's got to administer the retirement plan. We want their wealth advisor, because we're going to be working on some tax planning, some estate planning, and how that impacts the owner. And then on the other side, you've got the people who are effectively buying the business. You can't just plan this with owners and not have someone represent the employees. So this is also another big misconception. Every engagement we do, we're going to introduce the owner to an independent professional trustee. They have no interest in running your business. They don't know how concrete contractors work. They don't know how an architecture firm, well, they do, but they don't want to run it. They are solely there to protect the employees. They are a fiduciary with legal responsibility to make sure that someone's not taking advantage of these tax advantages simply to take advantage of the employees. So they come in, they interview 3 trustees, they pick the one they like. That trustee has an independent valuation firm who's going to look at that full fair market value. just kind of to share, the entire ESOP community nationally is maybe 1,000 advisors who are truly vested in this, in creating these ESOP employee-owned structures. So the relationships between all these people is really strong. Everyone knows the goal here is to really do what's right for the owners and the employees. So they'll bring in the valuation, they'll have their counsel, potential lenders. The best lender is always the one that knows the owners, knows the business. But if for some reason they're not comfortable or they don't have a credit group who understands these, there are a number of national banks, as you know, Emily, national banks, regional banks, who not only like these, love these. And you'll see why here in a second, because ultimately it will become a debt-free company and a tax-free company, which is the best client a bank can have. And then their lenders counsel to kind of go through the lending and debt structure. So we talked about full fair market value, and I'm trying to make sure we keep on time here. It's a lot to go through, Emily. So
you're doing great.
Yes. Okay. Thanks. So the valuation, so full fair market value, and I won't go into how all this works, but effectively, there's three methods for valuing a company. You're either buying the future earnings of the business and you're paying a discounted amount, discounted cash flow. You're looking at comps or market of what other business is sold for, and then you're looking at the physical assets of the business. The only thing that's important to understand is the tables. There is data available to us and to every other financial buyer, strategic buyer. We all use the same information. There's Pepperdine, there's public companies, there's Cap IQ. And these tables are updated regularly of what a business is selling for at that moment in time, based on size, based on industry. So going back to our real estate example, this is kind of comps in the market. That's where you start, but that's where the art behind the science comes in, because you really, and this is why we have valuation experts, have to go in a level deeper and say, are you similar to the comps? Where do you vary? Where are you better? And that's why you really want an advisor, because if you're better, and most of these companies are, you want to be able to tell that story, why you're better, why your growth, why you're going to grow faster than another business might, why you have a unique position, et cetera. But all in all, the data is exactly the same as any other buyer would use, because they're all valuing businesses. And this is where any transaction begins. So when we come up with a full fair market value for the business, it's based on the same data. And so owners can feel comfortable. By the way, this is also why this is very appealing in a lot of cases of what we call a company divorce. It doesn't mean it's contentious, but maybe there's two partners, siblings that own a company together. One's ready to be done and one is ready to continue to run it. They can feel rest assured that with this structure, one can exit and still get full fair market value and trust that it's the best. This is really what it's represented. They don't have to kind of negotiate it. So we do a lot of those as well. So what this means, we talked about those tax advantages, and just to put it to numbers, because this tends to tell the story better. If you're looking at a traditional third-party sale, that's on the left, as compared to a right, and I'm not going to go through all these numbers. Please don't feel like you have to understand the financials here. With an ESOP, where you exercise a 1042 exchange to either defer or eliminate cap gains. Now, in this case, there's a 6.99% state cap gains tax, because we work around the country. We obviously don't have that here in Texas, so it would just be the 18 million. But what you can see is there was a taxable gain of 92 million for this business, but there was another 18 million that was going to go to taxes after proceeds. So the actual amount the shareholder nets is 73 million. Now, as opposed, if you sell tax-free and you like the 1042, you get, in this case, 25 million more after taxes, which means the initial bid from a third-party buyer would have had to be 43% higher to net out to that after taxes. So this goes back to, am I getting full fair value? Are we talking about on the initial bid? Or are we talking about how much you're actually receiving of those proceeds? So we'll walk through this with a lot of owners where, going back 20 years, our firm actually did traditional third-party transactions. And then when they started working with ESOPs, they began showing all of them side by side, and owners kept selecting for a very large majority to go with the ESOP formation when they saw the tax impacts. So coming back to the tax benefits. So we talked about on the front end being able to elect a 1042. Again, we have to work with each owner to look at how that's structured and what makes the most sense, but they have the opportunity to eliminate the taxes on the front end of the sale. The business can become a tax-free entity. Now, how long that takes depends on the unique structure, and we work with them on that. There are additional contribution deductions. We would work with a team at Lane Gorman, where you can make contributions prior to even the formation, which flow directly through the owner as direct tax savings even prior to the formation. So again, why we have these advisors. And then getting a little into the estate wealth planning, there's some things we do with estate wealth with warrants, which is where that's that second bite at the apple. We'll talk about that in a second. But there's a way to go ahead and gift those warrants, which is just a future option on the growth of the business, but you can gift them almost immediately to your heirs and to a trust. Doesn't use up any of your lifetime gift exemption or your estate taxes. So we want to make sure we're addressing every aspect of this within the financial planning for the owners and the management team as well. So the next question I get, and I think we're going to get here. So if the employees aren't putting up any cash and the owner's getting bought out, then how are the proceeds? Who's paying for all of this? So the typical debt structure and the way this works is this is an example of a business that's worth $85 million. So let's say it's making $15 million in EBITDA. So for anyone on the phone, EBITDA that may not have heard this term, it's earnings before interest, taxes, depreciation, amortization, but it's kind of what the world considers, if we held all else equal, this is the earnings of the business. So this business is making $15 million. There are these banks that we talked about that really understand these. You go to the bank, so this is an amazing company. We've already done a feasibility analysis on it. The trustee with the legal responsibilities looked at it. The valuation firm has looked at it. Everyone agrees this is a great company. And it's making this $15 million will continue to grow. So we asked the bank for 2 times that amount in lending. So we'll say 15 million, give us 30 million. And there's a lot of banks who say this is great. So they'll give us $30 million. We usually negotiate an additional line of credit above that. Most of the owners we meet have lines of credit they never even drawn upon. But we just want to make sure that as part of the structure that it's available, working capital, should supply chain take a hit again, COVID take a hit, you just want that there as a safety net. But the 30 million comes in. The rest of the business is going to be put on a seller note owed to the owner. So think of that as, we've got the 30 million from the bank, and that's tied to a loan, which could be paid out technically in 2 years, plus it's going to be tax-free. And then the remainder is going to be paid to the seller on a note. That seller note is subordinated to the bank debt. And because it's subordinated, it will get a return of 11 to 12% on interest, which is a terrific return to the seller. Or they can choose a combination of interest and interest replacement warrants, which is that second bite at the apple. So most of the owners we meet are very excited about their businesses. I can't tell you how many 65, 70-year-old business owners I meet who want to show me their 5-year business plan. They're excited about it. It's going to grow. But again, they're trying to decouple having all the wealth in this business with this, but they want to be part of that growth. So in that scenario, I would say most of the owners choose to take less interest, and they want options for the business in 5, 6 years for that additional growth, which can be 15, 20% of the business's value, again, later on. So the seller note has a guaranteed interest over time, the bank loan, the line of credit. So how does this look when you play this over time? So as an owner, and this one I'm going to take a second, Emily, I'm just going to slow down here. I was worried about time, but now I'm saying we're good. So
you're good.
The gray bars represent the seller note. So the day that the employee-owned business is formed, there's that seller note and the term loan. And the seller note begins to accrue interest, right? Because it's sitting there, but the blue bar is going down because the earnings from the business are paying that debt down very rapidly. Remember, it also has the option to be tax-free. So now as the 15 million becomes $18 million, EBITDA without the T in there. Take the T out. So they pay down that term loan very rapidly. And then 12 months, 16 months later, you go back to the bank and you say, okay, we've paid the $30 million note down to 10 million, and earnings have gone from 15 million because we're now employee owned to 18 million plus tax free. So we want to up it to 35 million. So the bank is more than happy to loan another 25 million to the owners, which then goes directly to pay off the seller note. So that's why you see those gray bars drop and the blue line go back up. And then it begins accruing interest again. Same thing happens year 2, year 3. You just keep repeating that process. And this graph is not for every owner. We're working with one owner right now where it's only 3 years out. The business is growing so rapidly, he'll be bought out in 3 years, which matches his time frame. So we create this graph for every owner based on, here's that time frame of what you can expect to see. So as you can see, the seller note is getting chunked down by the re-upping of the term loan. The term loan eventually is all that's left, which gets paid down. This is why the banks who understand employee ownership love it, because in 6 years, you've got a business that is completely debt-free and now tax-free. And they tend to become very acquisitive. They buy buildings, they buy machinery and equipment, et cetera. So this also, now if you go back to where we were talking about that timeline for those owners, every time, I mean, like this morning with this, what's the owner's timeline? Well, he's 70 years old. You got to think his timeline should be 5, 6, 7 years just out of safety for the family, et cetera. But most owners I meet, that is the timeline they're looking at. They want to begin separating proceeds from productivity and then continuing to stay involved, but manage and using that time frame to develop and transition the work, the relationships, et cetera. Obviously, this is highly incentive to the employees and management, but let's look at what it looks like to the owner. And this is kind of that same thing, but just showing the cash directly to the owner. At close, they're getting a chunk of proceeds. Year 2, they're getting another chunk of proceeds plus some interest plus repayment of their debt. Continues on. In this case, this was an owner who chose warrants. If they didn't choose warrants, you'd just see the interest being a bigger portion of it. But in this case, they're working along. The red line represents the enterprise value for the business, but because of the interest in the warrants, they're actually getting even higher than the fair market value for the business when they first went to look at this. And that red block at the very end represents those warrants being exercised. Again, looking at tax planning, warrants have a long-term capital gain treatment. If you were to just take it as interest, it's ordinary income because it's just interest payments being made to the owner. So we also work through with the wealth advisor, the CPA, and the owner to make sure which one makes sense. But I'm fortunate the owners I meet are very excited about their companies and they almost always want warrants. So this is what the proceeds to the owners look like. And then finally, this is outside of the ESOP, but it's part of the formation. We have an opportunity to do what's called stock appreciation rights. So even though management, as we talked about earlier, is accumulating wealth in their ESOP, just like the employees, they're building that, but you can also create, these are non-dilutive to the value of the business, but you can set aside what are called stock appreciation rights for key management. So if you've got those 4 or 5 people that are just critical to the business, you set these stock appreciation rights, and as long as they're meeting the objectives of the 5-year forecast, each year they meet those objectives, 5 years later, they're getting stock appreciation rights as a bonus, if you will, in additional stock for what they've achieved. So in this example, year 2, you can see that they receive those funds in year 6. In year 3, if they hit their targets, they receive additional funds in year 7, 4, 8, 5, 9, etc. And these are significant. And this is real useful because we meet with a lot of management teams who are talking to owners saying, I want to buy into the business, but I can't, this is part of that I can't afford to. So we can layer this in along with it. And the reason, think about that trustee is saying, well, I'm trying to protect the employees, right? They like these because my owner's incented for the company to succeed because they're being bought out, they've got warrants, etc. The employees are incented because they're building retirement in their ESOP retirement plans. And now we've layered in another aspect for key management to be incented. So everyone is rowing in the same direction. And this is why you start to see these very stable, very growth-oriented companies where everyone is working towards the same objective. Now, back to your question, Emily, when you mentioned, could you use this to attract? Well, let's say you have 3 key management members, but you need to go attract 1 or 2 more. You can create these stock appreciation rights and set them aside and use them to give to somebody as part of a recruitment process. So let's say you wanted a CFO, you don't have a CFO and you know you're going to need a CFO or a vice president of sales or whatever, you've lost your, someone took your vice president of sales. You can take these stock appreciation rights and say, hey, if you come here, not only will it be employee owned, not only will we be transitioning this over the next 7 years, but there's also a significant financial incentive to you to come here, achieve and exceed these targets. So when you weave all these together, what it comes down to, and this was kind of the beginning, again, I was worried about time, so I think I went faster than I needed to, but I do want to kind of lay out But okay, what we wanted to lay out was side by side. Why is this more of a succession plan as opposed to a traditional exit? So I think I kind of, went over pretty heavily, the taxation advantages, that this is a tax advantage structure that Congress has created to encourage owners to look at these. Again, we don't know if it's, I get asked all the time, Emily, you've heard this question be asked, is this business an ESOP? Is this business an ESOP? And I say, I don't know. Any successful business can be an ESOP. But what I do know is it's the one universal buyer. They should at least look at it to see if it's the right solution for their goals. So we can eliminate taxes, liquidity, payout, and predictability. A third-party sales is more cash up front. And then there's usually contingencies called clawbacks and earnouts. Bruce, the problem with an earnout or clawback is you have a complete contradictory set of motivations. You have an owner who is trying to achieve financial targets as he's exiting the business, and you have the new owners of the business who control the business. And so I will quote Bruce Lazear's wife, Sherry Lazear, who was a litigator her entire career, who said, and I've told this joke to many an attorney who laughs, earnouts are the greatest thing to happen to attorneys in the last 20 years. Because there's this idea that I'm going to be able to hit these targets, but I think most owners now have heard from other owners that it's often contentious and creates conflict. This is upfront in a fixed, predictable set of proceeds to the owner. Disruption to the operations. Owners are able to look at employee ownership in an ESOP plan with basically minimal specialized deal team. Usually it's, in most cases, it's the owner and a CFO, maybe a few business unit leads if they're extremely large. In a third-party transaction, it's a material disruption. They're going to do Q of E's, they're going to talk to vendors, they're going to talk to customers, they're going to want to talk to key employees. They're doing their due diligence, but it makes it where it's very well known that the business is in flux and it can create disruption to the employees. Impact on the employees, it's unpredictable. I mean, I can't say in a third-party transaction, you just don't know what the impact's going to be. In employee-owned businesses, it's always positive. I like to tell people we have the best parties. Whenever we do a formation, everyone celebrates, everyone's excited. I always tell them too, then it's a little anticlimactic because the next day, you know what they do? They go back to work. Yep. They go back, they're just a little happier and they work a little harder, and the plan has been put in place. Another big consideration for owners, especially as they're getting older, is the likelihood of closing an employee-owned transaction is rough. If it goes through feasibility and everything makes sense, and the owner feels like it fits its goal and the management team as well, the odds of it happening are almost 100%. We say the almost because usually that's at the owner's discretion. They wanted to go buy a building or something happened, but it is pretty much going to happen. Depending upon which articles you read, third-party transactions fail anywhere from 50 to 75% of the time. So for a lot of owners who are just ready to have something that is a surety and they want to make sure it's going to happen, the likelihood is much faster. We don't have this on here too. Typical formation, once we've been through feasibility, worked with an owner, if an owner moves forward, depending, I mean, if there's a hugely complex structure, it can take longer, but it's usually a 4 to 5 month process. For most people who've been through a third-party transaction, it can take 9 months to a year, and then there's no certainty of close. So it's much more of a likelihood of close. And then kind of the point of this conversation today, the post-close involvement, which creates that succession plan in a third-party sale or exit of the business, that is something negotiated with the buyer. Your involvement, your people's involvement is a negotiation, and it's really kind of a buyer discretion of what makes sense to make the deal happen. In an employee-owned business, it's the seller's discretion. They get to design their involvement. They just have to be able to show that this 5-year forecast in the business will continue to either have a management team or be successful, and they can begin that transition. So that kind of goes back to the whole point of this, why more owners are looking at this as a succession / exit as just a true financial exit.
You got it.
I normally do that in 2 hours, 51 minutes on the clock.
Well, Doug, I've had a couple of questions personally sent to me, but if we look into the Q&A section, if you want to go ahead and answer a couple of those questions, we got one from Michael and we got one from Jonathan. And then after that, I'll ask you the question that I was messaged directly.
Okay, so Michael, hi, good to see you. I know you. So, Michael, you always have good questions. So it really depends. So I will tell you this, you bring up a great question. So the question is, if the company is leasing facilities from a separate real estate company from the operating company, do you sell both to the ESOP at the same time? Michael, great question. The answer is, it's up to you. I will tell you that the majority of the owners I meet here in Texas, I know you're not in Texas, but the majority of the owners I meet, they own the buildings they're in, and they typically want to keep the buildings they're in. They want to ESOP the business, but they'd like to keep the business. Now, if you contribute the real estate, obviously it goes straight to the value of the company because it's got flat real estate value. If you decide to keep the real estate, we can ESOP the business. The big advantage for an owner is you have a long-term tenant. As long as you're charging a fair market value for rent, the business is probably going to stay in your building for the next 30 years. If you sell to an outside party, they might sign a 5-year lease, but at any point down the road, they might move the business into one of their other facilities. And there's a pretty good chance of that. If you're out in a rural area, let's say you do have a business in Sulphur Springs, you might now have an empty building with no company. So this is very attractive for a lot of owners that want to know that I can keep my real estate, keep my tenant. It has to be fair market value lease. You can't, you can't charge them $1 million a month once you ESOP the business. So good question. Kevin Rackers, can you explain the warrants a little further in regards to the estate plan dynamics? So thank you for doing that. I know I brushed over that real fast. So a warrant is just an option for, stock in the future. So these owners that are very excited about the future prospects, basically in lieu of that interest on their seller note, they get a bundle of options for future growth of the business. Well, options today are worth almost nothing because they're based on a future value. So let's say you have options and they're worth 50 grand. You could gift those immediately, which we almost always recommend, to your heirs, to your trust, because they're not going to eat up I don't want to prognosticate politics, but everyone believes the estate gift limits are going to come back down to 5 million. I think they're 11.3, 22.6 for a couple. They're going to come back down. And for a lot of these owners, they're trying to figure out how to gift as much as they can. Well, if I gift these warrants today for $50,000, and in 5-6 years, they're going to be worth 10, 15, $20 million, they grow outside of my estate, and therefore they're not applicable to that tax. Now, as my heirs pull that money down, they've got to pay tax on it, but it's not applicable to the gift tax exemption or to an estate tax if you should pass. Can you have SARs and warrants in an S corp? Yes. So yes, Jonathan, good question. That was easy.
You got it. Now I have a couple that were sent to me directly. And the first one is, ideally, I know there's no perfect shape and size for an ESOP, but ideally, what size company do you think would benefit from an ESOP?
Great question. So number one rule, it's employee ownership. So you have to have employees. I know that sounds, but typically our feeling is 20 or more employees. There's exceptions to every rule, but we feel like it's a good number where it makes sense to have 20 or more employees. Now, exceptions to that, I met with a contractor recently who had less than that. However, I asked him, I said, how many subcontractors do you use? He said 100. And I said, do you have 10 that you love? And he said, yeah, they pretty much work for me nonstop. Well, then would they want to join your business if it was employee owned and become sole employees and actually own the company and work for you? Maybe even add additional revenue streams. Right. That's pretty common in contractors as well as IT services where there's a lot of 1099. The second one we personally feel is 2 million in EBITDA or above, earnings are above. They can be done for less, but you don't get to pull all these levers and maximize all these things. And there is a cost to administering an ESOP. So, but you got to remember, we go back to that tax-free entity, right? So if I'm making 5 million in earnings and I'm saving $1 million in taxes, that offsets the fees I pay to get my stock valued, my trustee to sit on the board and check out make sure I'm not doing anything weird, and my TPA. Let's say that all, I don't know, 100 grand, 150, but I'm saving $1 million in taxes. I'm just doing the math in my head. I was told there'd be no math. That's 850,000 more a year. But if you start getting into that $500 million EBITDA or 800 million EBITDA, personally, we feel like that's getting kind of tight. And then the third piece is you have to be able to have a succession plan. It's not a good option for a business owner that doesn't have someone to run the business, take over the business. or they're going to continue to be involved. If it's a situation like that, then a third party really makes sense.
Well, this has been super insightful for me, and I know everyone else who's attended. You know this, that I tell you this all the time. I'm a big ESOP fan after knowing you. I've always heard the phrase, people care about what they help create. And I think that really is kind of the definition of an ESOP. And I want to thank you, Doug and Lazear Capital, for coming on and giving us all the intel and all the information we didn't know about ESOPs before. But also stay tuned. LGT throws tons and tons and tons of events throughout the year. If you'd like to learn more or sign up for any of our events, go to lgt-cpa/events. I'm Emily Ackerman, Director of Business Development. Feel free to reach out to me on LinkedIn with any questions you may have. Same with Doug. But this has been super insightful, Doug. Thank you so much for coming on and telling our audience all about ESOPs. I hope they hear some of the buzzwords that make sense for some of our own clients to maybe have that succession planning option. So thank you so much.
Perfect. Thank you, Emily. Thank you, Leigh Gorman.